Let's look at capital versus revenue expenditures. We know that capital expenditures are those expenditures that are going to be around more than a 12-month period, an operating cycle, a year. Those things that last longer than that period is capital. Anything shorter than that is considered a revenue expense. Generally, those are routine, regular expenditures that are small in nature, but necessary. Those are going to be considered revenue expenditures. Big costing items, items that extend the life of a tangible asset, those are going to be capital expenditures. Let's look at what your book says. Plant assets include buildings, equipment, land improvements, leasehold improvements. In the previous chapters, we discussed certain assets such as buildings and equipment related depreciation, as well as land that is not, as I mentioned before, not, and you can underscore in your book, not, land is not subject to depreciation. However, let's discuss plant assets, acquisition, depreciation, and disposal in greater depth. But first, we've got to differentiate between capital expenditures, revenue expenditures. Here's the description. Capital expenditures are material, I would underline that word, material expenditures that will benefit future accounting periods and are therefore initially recorded as assets. Revenue expenditures are expenditures that either benefit only the current period and are immaterial. Therefore, they are initially recorded as expenses. Let's say that again. Capital expenditures are material, and the benefit is for the current and the future accounting periods, and they are recorded initially as assets. Whereas a revenue expenditure is an expense. All right? Capital expenditures are assets. Revenue expenditures are expenses. And where do expenses go? They go on the income statement. And they either benefit only the current period and are immaterial, and they're recorded as expenses. So therefore, you now have a distinction between what's capital and what's a revenue expenditure. Revenue expenditures are only for the current period, whereas a capital expenditure is an asset that's recorded and used for future periods. Let's read on. Major improvements and betterments of plant assets extending their life, such as building additions, major capital renovations, are capital expenditures. Expenditures for routine repairs and maintenance of plant assets, such as fuel operate plant assets, are revenue expenditures. Some expenditures may meet the future period benefit requirement of capital expenditures, but may be too small or immaterial to be worth capitalizing. Therefore, if it's too small, if it's immaterial, even though it affects and benefits future periods, it still remains a revenue expenditure. And we'll get into some examples later on, and I'll provide you with some homework that you can do to help you better hone in your skills on revenue versus capital expenditures. Let's move very quickly to plant assets and acquisition costs. Generally speaking, in this area of plant assets and acquisition costs, and we're dealing with capital assets, and as we deal with these capital expenditures, you have to add into the cost of that asset everything it took to put that asset in place. So say, for example, I bought a big piece of machinery, and that big piece of machinery cost me $10,000. I had to have that machinery shipped, which cost me $2,000. I had to have that piece of machinery installed, which cost me $1,000. All right? There was sales tax attached to that piece of machinery, which again cost me another $800. So let's detail it out. I have a piece of machinery, which cost me $10,000. Shipping on that machinery cost me $1,000. Installing it cost me another $1,000. And then we have the tax, which was $800. That machine now costs me $12,800 as an acquisition acquisition cost. That acquisition cost is the cost of acquiring that asset and making it available to be used. All of the costs associated with putting that asset in place, getting it ready to be used, so all I got to do is click the button, is called an acquisition cost. Let's look at the example and how these costs are capitalized. ABC Company purchased equipment, $100,000, June 1st. It's a regular customer of the seller of the equipment. The manufacturer gave him a discount. So guess what? He's not going to pay that $100,000. The manufacturer said, pay $36,000. There's a 4% discount, $36,000 down, 3-month no payable, 5% rate. The vendor used an interest rate. Had interest of $250 due to the vendor at the end of each year for the next 3 months. Principal of $60,000. In addition, they paid for the following: sales tax, $4,800. Delivery costs, $1,200. Installation, $3,000. When it was delivered, it fell off the truck. Another $500 for repairs. Let's look at how this thing is capitalized and reported. We have the list price of $100, less the discount of $4. Subtotal, $96. Everybody got that? Sales tax, $48. Delivery costs. Installation costs. Now we have the total cost of $105,000 for the equipment. Now, what it says as a special note is that the $500 to repair it is not capitalized because we are repairing something that had nothing to do with installing it. It just happened to be a incident that occurred that was outside of it. Had not happened, we would not have paid that money. But this is just a repair expense because, number one, it's incidental and not directly to putting it in service. It is incidental. These costs are directly involved with putting this particular piece of equipment into service. That's pretty much all you need to remember on this, that acquisition cost does include additional costs of putting the item into service. More to come on depreciation method.